I'm Sean Cooper, president and owner of Fit Financial Consulting, LLC, a registered investment advisor. Last week, we talked about two methods for analyzing securities. The first being fundamental analysis and the second being technical analysis. This week, I want to delve deeper into what I personally emphasize when I'm evaluating mutual funds, ETFs, exchange traded funds, and individual securities. But before we delve too deep into it, I want to analyze or at least evaluate those three options first. The first is individual stocks. Now, individual stocks can often be the most cost effective from a long-term perspective, and that's because there are no internal expenses associated with individual stocks. There's not an active manager that's providing ongoing oversight. There's not typically a lot of ongoing trading. So the cost associated with investing in individual stocks is really just that initial trading cost. The challenge, though, is really the time commitment. So the ability to conduct the analysis on each individual stock and choose the individual investments over time. So, and choosing just one stock often has pluses and minuses. On the one hand, yes, you have much higher potential for high or outsized returns with one individual stock, but you also have a much higher potential for losing your entire investment or a much larger portion of your investment. So that's why it's typically advantageous to diversify your portfolio, but that's where you kind of end up with a smoothing effect where one individual stock isn't going to necessarily impact your portfolio one way or the other. With that said, again, the biggest disadvantage is really that time constraint. The ability to conduct the research on each individual stock is often not an option for most of us. In order to alleviate that burden, that time constraint of being able to analyze each individual security, portfolio managers developed mutual funds. These are pre-diversified portfolios that you can utilize to gain the advantage of that diversification, and they also present the additional benefit of the ongoing service of due diligence on all of the individual holdings inside of that particular fund. With that said, it brings with it much higher costs. So, and that's in the form of internal expenses. If you read through the prospectus of any fund, you'll find that the average fund ranges, the internal expense ranges from about 1 to 2%. What most people are not aware of are the additional fees, the additional internal expenses that are not disclosed in the prospectus, that are actually only disclosed in the SAI, the Statement of Additional Information. And once you evaluate those internal expenses, you'll see that the overall cost of most mutual funds is about 40% higher on average, so it can be fairly significant. For those fee-minded individuals, you can build a diversified portfolio through the use of ETFs, that's exchange-traded funds. These are a much lower cost alternative to the active mutual funds. ETFs essentially track an index in most cases, so something like the S&P 500, the Russell 2000, MSCI EAFE, something along those lines, which means they don't have a need for an active manager because they're just tracking an index. And that active manager is what adds the bulk of the cost, the internal expenses. With ETFs, you're typically looking at somewhere around 0.1 to 0.6% on the internal expenses versus the 1 to 2% on the mutual funds. However, you do lose the advantage of having that active manager. So far, we've discussed the low-cost alternative of building a portfolio with individual stocks, as well as the diversification benefits of mutual funds and ETFs. So where does that really leave us? Well, research out of the big institutions and colleges really suggests that active management doesn't pay off on average over the long term. And basically what you're looking to achieve is diversification while controlling costs over time. So if you have sufficient assets to build a diversified portfolio of individual stocks, you're in great shape. Again, that also involves the time commitment of choosing those individual stocks and bonds in most cases. For most of us, though, diversifying and keeping costs low through the use of ETFs may be a better bet. In some instances, you'll find that mutual funds might fit the particular market segment you're trying to achieve better than ETFs, in which case they may be a better bet. In fact, one of the first things that I evaluate when looking at ETFs is how well it fits the market segment that I am trying to target, whether that's international large cap growth, domestic small cap value, commodities, foreign bonds, etc. Doesn't matter what that is. The more specific you can be, the better you can tailor the portfolio to fit your individual needs. The second thing that I look for is that low internal expense ratio. Keeping costs down, honestly, is one of the biggest things that you can control within your portfolio that will actually impact your returns. With that said, you don't want to lose sight of the purpose of each individual investment in the process of chasing those low internal expense ratios. When I'm evaluating mutual funds, I'm really looking for the same things that I am in an ETF, but with a couple additions. The first being the manager, actually the bulk of it being the manager. First, I want to know how much experience that particular manager has, and also how much the tenure of that manager with that particular fund. I might find a mutual fund that I find very attractive, but if I find out that the management team has just turned over, it's a brand new management team, I'm not going to be nearly as confident in that particular fund as I would be if that management team's been with the fund for 10 plus years. I also want to know what that manager's done in the past. I want to make sure that the manager is not going to create drift within my portfolio. What I mean by that is if I buy a large cap fund, I don't want it to suddenly start looking like a small cap or a mid cap fund. That would dramatically change the overall risk of my portfolio just because the manager is probably chasing returns. And that's very undesirable from a portfolio construction perspective. Finally, when I'm evaluating individual stocks, the first thing I look for, and it may sound simplistic, but it's really the price. I've conducted quite a bit of research and ran a number of multiple regression analyses evaluating historical data. And the number one predictor that I've found time and time again over the long term, so 10 plus years, is the initial price at which you purchase the stock. And it really goes back to that basic principle of buy low and sell high. And the lower price really makes it easier to generate higher percentage returns. So an example of that would be if you buy a stock for $100 per share and you earn $5, you made 5%. If you purchase a stock for $10 and you made $5, you made 50%. Now, keep in mind that does work as a double-edged sword. It goes both ways equally well. So at least from a percentage standpoint. Additionally, it presents an obvious issue in that by targeting lower priced stocks, you might not be purchasing stocks that are undervalued, but stocks that are actually in financial trouble. So you don't want to stop your analysis with just the price, but it is a good starting point. The second thing I look for is steadily increasing dividends. So I tend to avoid non-dividend payers and excessively high dividend payers because they're unsustainable. The thing I like about dividends is they tend to bolster returns in bull markets and they buffer losses in bear markets, which really can help smooth out the ride for your overall portfolio. Furthermore, I really want to look for stable or steadily increasing dividend payers because those tend to signal financial strength. The excessively high dividend payers, you get up to 10, 12, 15% yield on the dividends. Oftentimes those are companies that are actually trying to attract investors when they don't have the financials to back it up. So I tend to avoid those as much as the non-dividend payers. And with that said, if you are targeting dividend payers, you're automatically going to rule out the younger companies that are in a growth phase. So if you're looking for those startups and things of that nature, dividends is not something you're going to want to focus on. The final thing that I look for is cash flow from operations. And I rely pretty heavily on this particular factor or ratio because I'm looking for a company that can pay off its short-term debt, through the use of their own operations, their own cash flow from operations, a company that can stand on its own two legs. I don't want a company that's great at raising capital through financing to pay off debt. That's not a good long-term strategy. Yes, it's important that they can raise financing, but it's not a long-term strategy from a debt payoff and a continuation perspective. You're really looking for cash flow from operations on that front. And I know I've gotten a little bit into the weeds with this particular video. It's still been really the broad strokes of my personal analysis of individual stocks, mutual funds, and ETFs, but I do hope you found it helpful. If you have any questions, need anything else from me, give me a call at 720-808-6979 or shoot me an email at sean.cooper@fitfinancialconsulting.com. Thanks.